Hey everybody, it is Wednesday. That means it's managing an options portfolio today. Glad you're here. So appreciate you. Today, I want to talk a little bit about backtesting a little bit with options. And of course, we're going to manage specific positions in a portfolio as well. But hey, if you're watching live, great. Invite you to participate in the chat. Connie's there in the chat, Connie Hill. And make sure you check out some of her webcasts as well and follow her on X. You can follow me on X as well, at Brent Moore CS, at Connie Hill CS. And I'll try and keep an eye on chat, but Connie's there as well to help me out on that too. So there we go. Now, before we get too far into this, let me just mention a few things. One, options do carry a high level of risk and are not suitable for all investors. Multiple leg option strategies will involve multiple transaction costs. I may not always look at the fees or commissions on these trades, but just realize they're a real thing you got to consider there. Now, the material today is intended for general, informational, and educational purposes only. The paper money application, which is what we will be using, is for educational purposes only. It's a demonstration. It does a lot of things really well. One thing it does differently than the live platform, though, is it does not assign short options early. So just be aware of that difference there. And Schwab does not recommend the use of technical analysis as a sole means of investment research. And all investing involves risks, including loss of principal. Past performance is no guarantee of future results. There we go. All right, everybody. Hey, let's head on over to the thinkorswim desktop software platform. This is the S&P 500. You can see we're pulling back a little bit today, but the trend is the trend, and the trend keeps going on strong. This is a 20-day moving average. This is a 50-day moving average. The 20-day moving average has been above the 50-day moving average for a while. That's one way to kind of help give you an idea of what the trend is. I'm not saying you need to use 20 and 50 exactly. Some people will use a 10 and a 30, 10, 40, 5, 30. It's a common way of kind of identifying, what the market is doing. Some traders will come up with a bullish posture, bearish posture with that. Now, there's a lot of different ways to trade on the market. One thing I always encourage you to do is to have a plan. And what I mean by that is, what I don't want to come across as some kind of vague notion of what you're going to do in your head. I would actually encourage you to write down your plan. Now, if you go to the schwab.com website, which I have here that I temporarily misplaced. There we go. We have some plans there. They're not intended for you to follow exactly. We want you to create your own plan, but it's a good starting point. How do you find them? You go up to Learn, click on Courses. There's other ways to get there, I think, but this is how I usually get there. And after you click on Courses, sometimes it doesn't go to Courses. Sometimes you got to click on Courses right here. Click on Courses right there. And here you have your courses. With a lot of these courses, it gives you sample investing plans. Okay, just to give you an idea. Fundamental analysis. I'm going to click on the fundamental analysis course. Even though we're not talking about fundamental analysis today, we are talking about plans for a sec here. Stock investing with fundamental analysis, fundamental value, sample investing plan. If I click on that and open it up, it gives me a plan. And these are some of the elements of a plan. We have an objective, watch list criteria, entry rules, exit rules, money management. We talk about this in this class quite a bit. Having these ideas of what you're going to do, how you're going to trade options, stocks, whatever. Now, if I go down to the option strategies for beginners, directional option strategies, non-directional option strategies. Okay, let me go to directional option strategies. Click on that one, just to give you one more example here. Some sample plans. Let's click on it. Now, when we look at it, what we're going to see is, if you go down to the sample plan, objectives, watch list criteria, Sample entry rules. Notice it says sample. It means you do your own. These aren't recommendations. Money management rules. The same basic elements, the same basic skeleton of the plan exists for the various trades. But whatever your plan is, just have it, know what you're doing with it, okay? If you haven't looked at those, look at those. That's the first thing I want to get across today. There's some good ideas, various strategies. Not every strategy out there has a plan, but a lot of the ones that we do in these different webcasts will do that. Now, I'm going to use a very simplified plan today here just to illustrate, okay? If you want to back test, okay? Well, before I get to that, let me mention this. One of the great things about paper money is this. You can test out your strategies. You can test out your plan. Let's say you're saying, well, look, if the stock crosses above I have a 2050 crossover, okay? I'm going to just bring up Coke here. 2050 crossover. That means my red line, which is a 20-day moving average, crosses above my 50. I'm going to buy in that circumstance. So if I do that, you can do, well, we just kind of, it's been a few days since, it's been a little while since that, so maybe this wouldn't be what you'd be looking for. But you can see in the past, oh, we did that, that probably would have worked out in that circumstance. But sometimes not so much, in this circumstance, maybe not. I don't know. We'll see. But that's maybe an ideal way to test out your plan. But sometimes you want to get data quicker. It takes a while to do it, in other words, is what I'm saying. To use a simple plan of the 20 crossing above the 50 and the 20 crossing below the 50 as a sell, so this is a buy in this example, this is a sell in this example, it takes quite a bit of time to figure it out. And if you're doing a lot of trades and you want to get a bunch of trades, it can take a long time. How many trades do you need? I don't know, but I'll tell you what you don't need. You don't need 2 or 3 or 5 trades. That's not enough to give you a representative, a good enough sample to give you an idea of how your plan is working. A lot of traders will say you need like 30 trades or something like that to give you a true sample, a better sample on that. But if you don't want to wait for that, what you can do is you can back test a little bit. And you can go, hey, in history, how has this worked? Doesn't mean it's going to guarantee the future is going to work the same way. But one way to do that with stock, we'll get to options in just a minute, is you go and you can change the time frame on the chart. And I'm going to go to I'll go to 5 years day chart, okay? And I can go back in time and I can just kind of zoom in. Try not to cherry pick and find the time period where you think it's going to work best. Just find a random period, and you're going to have to do it on various different stocks. For my example, I'm going to use Coke, KO, of a 5-year daily chart. You got to be a little careful. If I switch to a 5-year weekly chart, this is no longer going to be a 20-day and a 50-day moving average. If I switch to a 5-year weekly chart, it's going to be a 20-week and 50-week moving average. But I could say, oh, I'm going to buy here. Well, what would happen if we bought here and we sold here? Okay, right there. How would it work? How would this plan work? Well, we can go and we could say, well, we're going to buy here at this crossover, and then scroll forward in time. So let me just give you an example of that. Okay, so let me get out of this drawing tool. Let me get to my Word doc. Actually, I'm going to move this off the screen for 1 sec. And we'll go, and I'm just going to do forward dated. So we'll do this one, okay? So I'll do both, because sometimes you see this and this looks like really good, but actually the price, by the time I get in, the stock's up here, okay? And I'm just going to use closing prices for this to make it easy. And I'm going to just write it down. On 11/11, so November 11th of 2022, the closing price was 61.32. That was our entry signal. When's our exit signal? We'll go to the day after. Our exit signal is right there. This is 1/23 of 23. And my closing price is, for closing price, where am I seeing that? I'm just looking at the top of the page. And let me write it down, then I'll kind of point at it. But because if I point at it, it's going to change the number. 60.23. Okay. So I'm just looking right up here where the C is for the close. Let's go to the next one. Okay. Crossover, next day, we're going to get in. Entry, this is, and I'm just going to do two of these. This is on 3/29/23, closing price 61.86, and I'm going to scroll forward in time. And we're going to get out when we have a big cross. Okay, this one was not looking so hot here, and so 5/31/23, exit at 59.66. Okay. Now this may be too simple of a plan, but just for our point, you can add other screens on here if you want. If you want to say, well, my 20 crosses above my 50 and I need my RSI to be pointing upward. That would be a little variation of this plan. Whatever your plan is, this is one way to back test with stocks. But and in this case, it wouldn't have worked out so well because look, we bought it at 61.32 the first go around, and we sold at 60.23. And the second go around, we bought at 61.86 and we sold at 59.66. So with this small sample size of 2 data points, it's not, we have some moderate losses there on this. Now it makes up for it if you then have like a big win, right? It's not all about the number of wins versus number of losses, because one factor is how big are the wins when you win and how big are the losses when you lose. So, if you catch one like this one, we had a cross right here, bought it around 62, and we ended up selling around 70. Okay, so one big win can make up for a lot of little losses, or vice versa. One big loss can make up for a lot of small wins there. All right. So, and Paul's saying it's not trending. So yeah, in general, a strategy where you're excuse me, where you're doing just a moving average crossover, the trend is a big factor in there. Okay. All right. All right, everybody. So I think we're good. I had a little something in my throat there. So that's my first point there on this. All right. Now, how do we do it with options? How do we do it with options? So I want to go to that. But at the risk of repetition, let me just mention this. You need a lot of data points. And it's not just number of wins versus losses. It's how big are the wins versus how big are the losses. In general, a moving average crossover system will probably tend to give you bigger wins. It has the potential for bigger wins if it trends up for a while. Whereas if it's kind of going sideways, you'll get quicker crossovers. You'll probably end up with more losses, but smaller losses in that case. Okay? All right. Now, in this case, Eric says the exits were both late. A lot of traders won't use the same entry as they do exit. In other words, our entry in this case was moving average crossover. Do you need to use a moving average crossover as your exit? No, you can switch it up there. Okay. Now, let's move to options here. Let's say we wanted to do a similar thing, but with options. So I'm going to do the same thing. I'm just going to go forward in time here. We'll do the same thing. We'll go to the next entry here. This one was actually earnings, but we had the crossover. And so I think crossover day after the post-earnings gap. Let's do this one with options though. So I'm going to say, so this was 2/11/25 was the date, February 11th of 25. And doesn't matter what the stock price is because we're doing an option. I'm doing a bullish. I'm just going to do a long call to start us out. And I'm going to say we're either going to get out on the crossover or we may have a time exit based on our options as well. So I'm going to go to do our next crossover. Our negative crossover. So this one worked out fairly well, just pure luck. Sometimes it works out, sometimes it doesn't work out. And that's not a recommendation of this. So we got the cross, go day after, 6/4/25. Now, from a stock standpoint, that would have worked out pretty well. Okay. What about from a long call standpoint? How do we do that? Well, you can use a tool on the Analyze tab called Think Back. Analyze, think back. I'm on Coke. I need to go back to the day that I want here. So I'm going to go to February 11th of 2025. There's two dates on this screen. The first date is up here, upper right. Okay, upper right. February 11th of 2025. That's your entry date. Then you got to pick your strategy. In this case, for a long call, I'm going to do what we often do with long calls. I'm going to go out about 50 days here. What are these options right here? If you look at your current option chain, you're not going to see these options. These options have long since expired. All right. This is why they call it Think Back. We're going back in time. These are options with option prices, I'll show you in a sec, with option Greeks that were available at this date back here, whatever date you choose there. So I'm going to go out about 50 days. Well, I don't have 50 days exactly, but what I would normally do in this circumstances, I would go out probably 45 days. And we're going to do a long call, and I'm just going to go at the money. Now, if I wanted to say, well, actually, I'm not going to go at the money because normally I don't go at the money on these. Normally I go to about like a 60 delta. So I'm going to pull up my get delta. Here's my delta at the time. And we'll go here. And this is the one. I'm going to click on this just as if I would have bought it at that time. Now, what's my exit? We could have exited and June, the technical exit was based on crossovers, was June 4th. Well, this would have expired by June 4th. We're going to get out with about 20 days to go on this. So I'm only going to hold this for about 20 days or so. So that's going to put it out, and we're going to have to just look at this. So from 2/11/25, so I'm going to go 3 weeks here. So that's 1 week, 2 weeks, 3 weeks, okay? So I'm going to click on this date here. Now, look at this. Here's my PL date, okay? This date up here in the upper right is my entry date. This date right here in my lower left is my exit date based on these rules. Now, in hindsight, Would it have been better if I bought out a 100-day option and held it longer? Yeah, I'm sure I would have done better on this trade. But we're trying to make this as realistic as possible. What is our PL open at? We would have made approximately $394, not factoring in commissions on this, $394 on this. We bought it back here, back here on this, okay? All right, so there you go. That's how you can do it for options. Now, Paul said you can do monthly, maybe look at the monthly. I think maybe you're saying look at the monthly contracts. Yeah, you could. We could have done this 65 days out, done monthly contracts. You probably would have got better bid-ask spreads, better liquidity on those, likely, if you did that. But I'm just trying to give you an example of how to use this think back tool here. Now, let's take another scenario. Let's use the same entry, but let's not do a long call. Let's do a short put vertical. I'm going to stick with a bullish trade because a 20 crossing above a 50 is a bullish trade. And I'm going to go and do, what would I normally do on a short put vertical? Well, I go out about a month typically. I'm going to go out 31 days. I'm going to go out and I'm going to go to, I usually use my delta, around 30 delta. Let me get a few more strikes here. Delta 30, we'll do 33 delta. I'm going to sell this. This is a weird one. Okay, look at that spread. Yeah, our options just aren't liquid enough on this to give us, so I'm not going to use that one actually. We have a liquidity issue on this guy. Let me get rid of that old trade too. Just be careful. Sometimes those trades linger around a little while. Do you see my issue here on this? Why I wouldn't use this? Normally I would walk away from this trade. If my bid price is 51 and my ask price is 212, I wouldn't do the trade. If my bid price is 36 and my ask price is 93, I wouldn't do the trade. We'd either look for a different contract or we would look at a different stock. So in this case, let me go to monthly contracts. I'm going to go 38 days here and see if we got, this is a little better, not ideal, but we'll go here, 72, and we'll go, hold that control key down. This is a short put vertical spread, okay? Now, what would my exit be? This was my entry. My exit on these is about 10 days to go to expiration. So 10 days before March 21st would be February 21st. So I'm going to go to, sorry, I said that wrong. 10 days before March 21st would be March 11th. So I'm going to go to March 11th here for my exit. And then we can see, we can compare our strategies. Short put vertical, in this case, we would have made about 41 bucks, okay? So in this case, it would have worked out. Which one would be a preferable strategy in hindsight? In hindsight, the long call would have done better. If the stock just went sideways, which would have done better? Well, this would, the short put vertical would do better in a sideways market. Okay, so before we move on, I want to go look at individual trades and talk about management of those. But you can use this to back test trades here in your system. Whatever type of option trade you want, okay? Whatever type of option trade you want, you can do. If you want to do single options, you can. If you want to do butterflies, you can change it right here. Okay, Duke says, I'm confused about these dates. Let me just go through this here. Okay, in case others are confused. This is the date that you're entering the trade. How did we come up with that date? We came up with that date because it gave us a 2050 crossover. Okay? Now, where did we put this date? This date is going to be when we exit. In the case of the stock, where we were using the 2050 negative crossover, we used that. In the case of the option, we could use either that or the date where we would have gotten out on the option, which in the case of a short put vertical was about 10 days before expiration, which is why I did March 11th when our expiration was March 21st. Okay? All right. Okay, so those are the dates. Good. There's the review of those. All right, everybody. Now, questions on this. Now, a lot of you are out there going, I wouldn't never use that 2050 crossover as my entry rule. Fine. Use whatever entry rule you want. Use whatever exit rule you want on this. But the point is you can back test these, come up with more data points to kind of test out this system. Remember, we're trying to give you a systematic approach on these. Why a systematic approach? Why do we say, hey, we'd like you to use a rules-based approach? Well, here's why. Okay. And for example, here's this is a long calls sample plan. You could use this. This isn't using the 20 and 50 day. This is a 50-day moving average uptrending. That's easy enough to look for on the chart. And you can look at the chart, close above the high of the low day. You can add that as well. I didn't want to get into all that. I thought the 20 and 50 would be a little bit easier for us, for our purposes today. But you can backtest this plan right here if you wanted to. And here's, options, date expirations, strike selections, and whatnot. Follow the rules there on this. We try and systematize this though, because it makes you more consistent. It gives you an objective entry. When you use an objective entry, this is the benefit of it. It doesn't guarantee a win. But if you do come up with a successful system, you know exactly what you've been doing. Think of it as a recipe. You're making a cake. You have a recipe. You follow the recipe, and if the cake turns out good, then, hey, we're going to continue to use that recipe. Now, there is a difference. Baking a cake with the same recipe is going to give me the same results each time. This isn't going to give me the same results each time. That's why you need a lot of data points on that. Let's say we're following those rules and they're not working out. We can look back and know exactly what rules we've been using that aren't working. We'll know we need to tweak it a little bit in that case. But if you kind of just like use these vague notions of when to enter and when to exit, you can't really look back and systematize it and come up with objective patterns on that. All right, let's move forward. Let's look at our portfolio here. So let me go, I'm out of think back. I'm back to real life here on this. We're going to go and I'm going to work my way up top to bottom today here, okay? I have CVS. This is a trade we did last week. This is just a follow-up. I think it was, if I remember correctly. You can always, by the way, if you're wondering, what date did I get in? Click on the quantity, and it gives you the date right there, okay? 5/29, which was actually, that wasn't even a full week ago. That was Friday. So this was a very short-term trade. It expires in 2 days. What was this? This is just a long straddle. What's a long straddle? Long straddle is you buy a call, you buy a put, same expiration, same strike, and you hope it moves. You hope it moves big. Okay? That was the goal. Why did we do this? Well, look, briefly, what our theory was, let's see, we got in on, what do we say, the 29th? Okay. On CVS. Let me go to CVS. CVS. Let me just go to our current chart. 5/29 was right here. All right. So the theory on this day was, look, we were coming down, looked like we were maybe bouncing right here, And the thought was it's either going to break below and maybe go a long ways. I think this was our entry right here. Okay. Or it was going to give us a bounce and go up. Well, it didn't. Okay. It didn't do either. It went down. I mean, it broke down briefly, but it subsequently reverted itself basically to the same price that we entered this straddle at. That's not what we want. We didn't care whether it went up or down. We just wanted to go up or down a long ways on a straddle. That's how straddles work. Well, in this case, it didn't do either, so we're losing money. We're down 46 bucks on this. Okay, fair enough. 2 days to go. Is there any value left in selling these? Okay, so because like if they're worthless, we might as well just hold on to expiration date on this. Okay. But they're not. In fact, we're actually doing okay on the call. So I guess it's gone up a little bit. Went from 158 to 190 on the call. So this has some value. And even on the put, which isn't doing great, we entered it at 116. It's down to 38. Since, not great. We're losing money. But hey, for something that didn't work out, that's not a terrible loss. But at this point, unless I'm expecting a huge move in the next day, which I'm not, we're just going to get out. Okay. Now, for all I know, it may move huge in the next day, but we're just going to capture what we can of this and still come out with something. So I'm going to right click on this and I can create a closing order. Now I can close a straddle. Click on that. Probably unlikely to fill at the mid price. I'm going to move off that a little bit and I'm going to confirm and send that. We're going to take our loss there and move on. Okay, so that's that one. I don't think we have anything in earnings right now. No, we don't. Let's go here. Let's look at these trades. XSP. Now notice, this is just a long put. Why do I have it in the long stock synthetics hedges covered call category? And instead of the long single options category? Because the sole intention of this wasn't a short-term speculative move. It was a hedge. We got in this. When did we get in this? At the beginning of May. So it's been just under a month on this. The feeling was, market's getting a little frothy here. I want to protect portfolio. Well, when you enter a hedge and the market continues to go up, you're going to lose money. Well, we've done very well because we have a very bullish portfolio when it's gone up. But the hedge part, not so much. We would be doing much better. We'd be doing $809 better if we never hedged it. But you never know. We didn't know what the market was going to do. This was to try and deleverage the portfolio a little bit. This was trying to lower our portfolio's delta a little bit there. In other words, when we're looking at our portfolio delta, we can beta weight it. I'm going to just go to the SPX, beta weight. And let me go to get rid of my groups here real quick so we can see the total. Here's my portfolio total delta right here. It's not liking that. There's something in here that it's not. Okay, this is good. We see this because sometimes sometimes you'll see this. You'll go to your beta weighted delta and it shows in A. Why is that? One of these line items is not working. That's this one. Why are we not working here? I have no idea why it's not giving me a total here on this, a delta on this, but that's throwing that off, okay? But you can get a sense here for our deltas on this, and the XSP was just to lower the delta a little bit on the portfolio, okay? Negative delta on that. At this point though, I'm I'm just going to get out of our hedge because we only have 15 days to go on it. And time decay is really going to wear on this probably at this point. Well, I don't know. There's not that much value left in it, to be honest. So you could go either way. You could just say, hey, I'm willing to lose the extra $120. How do I get the $120 from? 2 contracts times the current price, which is 60. That's how I got the $120 on that. So, yeah, maybe we're willing to sacrifice the $120 to keep the hedge on here for a little bit longer. So maybe we'll do that. Maybe we'll stick with that for now. Okay? So that's the rationale on that one. You can get out of that though, either way on that on your hedges. I'm going to bring my groups back though. I think it's easier to look at that. We're going to show our groups. Clear my drawings and go back here. Come on. Okay, we did XSP. What do we have on Apple? This is the covered call, okay? We've got 100 shares of Apple. We've got a short call. We're doing okay on this. We've made a little money on the call. We've held Apple for obviously a lot longer. We're doing very well on Apple. This was just to try and give us some benefit in the case of a pullback. Our strike on this is 330. That's the key on a covered call. What's your strike and what do you think the stock is going to do? And I'm just using basic technical analysis here. The trend has been up. And so we have a strong trend, but 330 is up a ways. We could probably, if we're expecting a pullback, and our 330 is probably about there on the chart, okay? At this point, I'm willing to take advantage of the time decay, which you get from the cover call, with the thought that, hey, the market's already pretty elevated. I'm thinking I'd be okay selling my Apple stock if we jump way up there, with the expectation if it does jump, it's likely to give us a pullback. So now, if we were a week to go to expiration, we'd probably get out of this. We still got 23 days. We're kind of in prime theta territory on this. Here's our theta on this. Time decay helping us out on this trade there. So I think we're going to stick with that covered call in this case there. All right, let's move forward to our calendars. Why is this not? Let me get rid of that. Come on. Sorry about that. We have stuff in here. I know we have stuff in here. It won't let me expand it. What do I have that's preventing this? It doesn't matter. Calendars. There we go. Okay, I just had to use my little roller ball there on this. Okay, we've got a few trades. I'm just kind of working bottom to top. We'll try and go through as many as we can on these. We've got Starbucks. What kind of trade is this? Well, different expirations. Sorry, different expirations, different strikes. It's a diagonal spread, okay? One is expiring in 2 days. So we need to get out of this, or could roll it too, okay? But diagonal spreads can be a little tricky to look at and know exactly where you want them to be. So that's one reason why I always recommend learning how to use the Analyze tab. Click on the Analyze tab. Let's put in our stock, Starbucks. Okay, and I'm going to go to risk profile and see what we got here on Starbucks. This does not, there we go. Make sure everything's checked. So here's where we are. This is the current price right here. And if you're ever unsure on that, by the way, you look over here, and if it says 0 and this is unlocked, that's our current price. Okay, so this is our current price, and you can see we're a little profitable on this. And are we bullish or bearish on it? Well, look, if we go bullish, if the stock goes up this way, this trade gets worse and worse and worse. Okay. If it goes bearish, we're actually okay. It, it it's not quite as good, perhaps, if it goes far enough, but we have quite a bit of wiggle room on this side. Now, remember, we have one is expiring in just a couple days. So we're going to look to either get out, which I think is certainly a fine choice. But if on Starbucks, if we're not bullish, if we think it's going to stay sideways or go down just a little bit, it may make sense on this. And for the most part, we've been bearish. We have a little bit of a bounce today, but our trend is going down. So if we're going to roll this, one thing you can do is you can model this on this Analyze tab. You can go here and say, well, if I roll out my June 5th short 97 call to a June 12th, so going out one more week, I said call, I meant put, 97 put, and I sell that one instead. There's different ways to look at this. But what I could say is, what if we no longer have this one right here? I'm just going to uncheck it. I'm going to uncheck it. That's what this would look like if we roll that out. Furthermore, we're bringing in a credit. What kind of credit are we bringing in? Well, this contract is worth about 90 cents roughly. This contract is worth about $1.60, $1.70 roughly. The difference between those two, so about 70 cents or $70 is what the roll would bring in terms of the cash. Make sure, though, when you're looking at it, this would be the new trade, that this conforms to what we want it to be. Our technical analysis says it should be. So we're just going to roll from our June 5th to our June 12th. How do I do that? I can just go to my June 5th, right-click, create a rolling order. Doing this isn't going to save us on commissions. We still got to pay the commissions of closing out the one and entering the other one. But there's our credit on this. And, so 80 bucks or so. Okay. And I'm going to confirm and send, and I'm going to send that. And if it fills, I may push it. I may tweak this. I'm out of time. Well, actually, I'm not out of time. I may push this. So we have time to push that here. I'm going to just tweak this and see if I can get this to fill. Cancel and replace this order. And go down here. So we're back closer to 70 cents now. And now it filled. Okay. So now what we've done is our diagonal spread on Starbucks, we've just rolled it out. And I think it probably ended up on NL. Where did that go? What happened? Try this one more time here. I'm clicking on the wrong thing. Starbucks. We have our long Starbucks. Where's our other Starbucks? Did I enter that wrong? Let me look at filled orders. Starbucks. I entered one. I closed the other. I should have a June 12th. Well, I'll look for that either. Okay, folks, that's what we got. So we talked about a bunch of different things today. Talked about back testing, rules. You need a bunch of trades to test out your rules. You can back test on options using ThinkBack. We went through the process of how to do that. We talked about managing. We did a diagonal spread. We did a long straddle. We talked about a hedge, and we talked about a cover call today. All right. So hopefully you found that helpful. Thank you, Connie, for helping me out in the chat, of course. Thanks to our producers, of course. And thanks to each of you for joining me today. Remember, you can subscribe and like the, if you like the webcast today, hit that thumbs up on the bottom. That'd be doing me a favor. And if you like this kind of content, subscribe to the Trader Talks channel so you don't miss that in the future. Coming up next, we have trading price patterns. In the meantime, have a wonderful day, everybody, and we'll see you all same time next week. Bye-bye, everybody.